So again, tonight's topically is massively in love with real estate investing. I'm going to make sure that you understand that this is an educational webinar. You need to make sure that you do your own due diligence before making any real estate investment. Massive Capital is a vertically integrated real estate company. We're a developer of Class A retail and town centers. We're also an owner operator for value add multifamily. We do have most of our assets are in the Texas market, but we have two smaller properties up in Denver, two sort of in the 40 units each in North Carolina, about 200 units in just south of Atlanta, Georgia. We do land development, building construction, and then building operations. We have partnered with a company called Realty One. They're on the development, brokerage, and other side. So Realty One is mostly a developer of retail centers. They have about $300 million in assets under management. Then Massive Capital itself, we have some multifamily. We have a development in X-Space in Houston, just under 1,400 units in apartment, and we have about 210 million in assets under management. So we do LP equity. LP is a limited partner. We're going to talk a little bit more about limited partners when we get going here, people that invest. We also have a triple net. That's on the retail side, leasing, brokerage. We also do land development, steel frame construction, and then we do have our mastermind called Massive Masters. And we'll talk a little bit about that later on as we go through this presentation. So one of the things I'd asked at the beginning, and obviously nobody can hear me, so sorry about that. If you've invested passively in multifamily, if you could put the number, so if you haven't invested, it's okay, put a 0 in. I see one of my friends, Julie, on the call. She's invested quite a bit. She's trying to catch up to me. Myself personally, I've passively invested 20 real estate deals, and I'm an active sponsor on 12 deals. 9 of those are with Massive Capital. So if you don't mind putting in the chat, I'd just like to get an idea. And I understand a lot of you are driving because of the time of this call. So there's a couple of ways that you can be involved in real estate, all right, on the commercial side. So we refer to it as actively passive. I know that sounds kind of like an oxymoron. What in the world is actively passive? Actively passive means that you have spent the time to become educated, you're involved in your deals, finding out, you're doing all types of different things. So we refer that to actively passive. A lot of people, you'll buy stocks in the stock market, you don't really research the company, or your company may have a 401k plan. You don't know, but the beauty of real estate is the fact that you can learn. That's why we do these Informational Tuesday webinars. Our goal is to help you to get a broad understanding about commercial real estate so that you can become an educated investor. It's very important for us to be able to understand it. And then obviously there is actively active. Okay, actively active are people like myself now that are sponsoring. So we may find deals. Myself personally, I'm involved in the raising capital of the deals. Partners are involved in operating the deals. So as an active investor, and we'll talk a little bit more about this later, you're the ones that are responsible for putting the deal together. You're the ones that are responsible for doing things. We do have a 3-day Centurion course. If you're interested in that, please make sure that you book a call with me. I'm happy to talk to you about that. There is a course in Dallas coming up this weekend, and we have another one in Austin the following weekend, and then we'll have one that will happen Houston, and then back in Dallas. Sorry about that. I'm going to put my link in here, and you can also scan that to be able to book a call with me. But I love to talk to you and help you with your real estate journey. So let's talk a little bit about the advantages of real estate investing. So I've made this sort of handy chart here. And I'm going to start over on the left-hand side. So cash or savings produces no cash flow, especially now, right? You're not getting any ink. You have no leverage. You're definitely not investing in real assets, and there are no tax advantages. So I want to make sure I'm clear. I'm not saying that you need to have some reserves so that if something happens in your life, you can't take care of it. You can't do the things. I'm not saying that. I'm saying don't use savings as investment. Okay, so a lot of people, not so much lately, but for a while we're buying bonds. Bonds can give cash flow, but they don't give you any leverage. And of course, you're not buying real assets. And yes, there may be some advantage. Now, the majority of invest stock. And so stocks, you can have some cash flow. You can have some leverage. You're normally not investing in real assets. Even if you invest in a REIT or a real estate fund, you're actually not really investing in the real estate asset. You're investing in a company that owns the real estate. It's a little bit different, and there are no tax advantages. I mean, there is a tax advantage that long-term gains come as capital gains, but there's no losses or passive losses that take off. So then obviously, if you're involved in real estate can produce cash flow. It doesn't always, depends on the type of investment, but it can produce cash flow. It can produce, you can use leverage. So when we buy a particular property, and I'm going to talk about one in a little bit, it was almost a $17 million property, and we have about $10 million debt on it. And so we use that leverage. If you've never read Rich Dad, Poor Dad, you need to drop everything you do tonight and tomorrow morning, and you need to start and read Rich Dad, Poor Dad. He really talks about the power of leverage. Obviously, when you're investing in real estate, you're investing in real. What a lot of people don't understand is, as a passive investor, you actually own a piece of the real estate. A lot of people don't understand that. So you own a percentage of the real estate. So for myself, again, I told you I've invested in lots of properties, so I own of over 2,000 apartments. I own a piece of a storage. I own a piece of a medical center. I actually own a piece of that real estate. And then obviously with real estate, there are tax advantages. So tax advantages are super powerful in the real estate space. Love them or hate them. On the last election, when Mr. Trump said that he pays no taxes, it's because of the tax advantages of real estate. So you can actually invest into a real estate, and you can get tax advantages in the form of depreciation, which is a passive loss, which as a passive investor, still in your W-2 job, you can use those passive losses against your passive income. Or if you're a real estate professional myself, you can use those passive losses against a actual so for example, we have a property right now. If you were to invest money in it, so if you put $100,000 in it, you would get about a $32,000 passive loss. And the beauty of passive losses that a lot of people don't understand, if you can't use it, it's okay. It stays not a use it or. So these passive losses will continue to roll forward until you reach a point where you can use them. And again, I'm not an accountant. I'm not a CPA. You need to make sure what works for your situation. It's different for everybody, and you want to make sure that you're able to get the best tax advantage. I always say this, especially when we have some of our tax sessions. It's not how much you make, it's how much you keep. That really matters. So you want to make sure that you keep. So again, what is passive investing? I didn't get too many answers, so I'm not sure where you guys are. So we're going to go through it a little bit. Why do people not passively invest in real estate? They're afraid. I know for myself, I was afraid. I didn't understand. And that's another reason why I'm always excited to do these educational webinars so that people can go ahead and learn and try to find out different things about it. But it was very scary. And I remember the first time I invested. So again, I mentioned to you that I've invested passively 20 times, and then I'm a deal sponsor on 12. So that's a lot of investment. And I'm not going to lie that there's still some fear in, right? Because you can lose your money. You don't understand. You don't know what's going on. And it's kind of odd, right? We put money in the stock market, and we've all seen, right? It's been jumping all over the place, going all different places. But it kind of like it creates uncertainty, but it doesn't necessarily create fear, purely because that's what we were taught to do. We were told to put our money. We're told that's where to invest. And again, I'm not saying don't have anything in the stock market. I used to have about 90% of my money in the stock market and 10% in real estate. And now I'm 90% in real estate, 10%. Now, again, that may not be what works best for you. You need to understand. But what I'm telling you is that the power of real estate, it definitely needs to be part of so I've created these 7 steps, and you'll see there's lots of pictures of me, so you'll never forget what I look like in any of my presentations. So the 7 steps to become a passive investor. And this may sound very simplistic, but there's a lot to it, okay? So number 1 step is you need to learn the power of passive investing. All right. So you need to learn, how can I make money on passive investing? You need to understand the power of growing your wealth. And we've got a couple examples coming up on the slides. But until you understand that, you will not really grasp the power. So again, read Rich Dad, Poor Dad. Understand about leverage, understand about buying real assets, understand all the things, because there is a tremendous amount of power investing in real estate. 90% of all millionaires in America have come so through real estate. And there's lots of pretty cool examples of how they've done it. I was just listening to a story about Arnold Schwarzenegger. When he came to America, he actually bought himself a fourplex and lived in one of the fourplexes. And he has quite a massive real estate portfolio. And he bought it. Other tenants paid his mortgage. It grew in value and he kept doing it. And that's how he became successful. Obviously, he did pretty good on his move, but this was one of the ways that he created a path to wealth for him. Step number 2, this is pretty obvious, but you've got to find them, right? So obviously the goal is that you work, create your income. You need to take a portion of that income, put it to work for yourself. So not trading time for money, but having your money go out there and work for you. And later on, I'll show you a very powerful example of how that can work. Number 3, you need to find a sponsor that you know, like, trust. I am here to tell you today that who you give your money to is super important. You want to spend time getting to know them. Part of the reason why we do these webinars every Tuesday is so that, or every other Tuesday, pardon, and we do lots of other educational events, is so that you can get to know it. You want to make sure that you are giving your money to somebody that you know, like, and trust. You want to make sure that they are taking care of you, that the deal is structured in an investor first approach. Super important. And again, it doesn't mean that we're the only people that you'll ever know, like, and trust. You should have some diversity in your portfolio. But again, you want to make sure that you're going, and when you have questions and you need things, you're dealing with people that are going to help you and answer those questions. You need to decide what type of investment you're going to suit. Every investment has different risks, different rewards, the tolerances. I always try to suggest to people that they would pick an asset class. I always picked multifamily because there was such a shortage of housing. There's such a need for things to happen in value add. I spent a lot of energy understanding it, so I really wanted to understand. But of course, I have some diversity in my portfolio, but you want to understand not only the asset, but the way that you can get rewards. So for example, on our multifamily, usually takes about 12 to 18 months, then it starts generating cash flow, and then we sell it in year 5, and that's where you make about 30% of your money on the cash flow and about 70% of the money sale. Our goal is to double your money in years, but there are other opportunities. So we have a new retail development. If you're in the Austin market, later in April, we're going to have a tour of one of our properties here, and it's a little bit different. So we buy the land, we build the building, we lease up the building, and we sell them. So that one is a 3-year-old. So again, it's a very different type of investment, not only in asset class, but in when you get paid. You're not going to get paid anything until we sell it because there is no cash. You need to understand, all right, you need to ask questions, you need to understand, you need to be able to go to webinars. I tell people, when I first started investing, I was going to 2-3 webinars a night. I was watching the replays, I was asking questions because I really wanted to understand, right? I wanted to know, what are you doing? What's your business? How am I going to get my money back? How am I going to make? So you want to make sure that you spend the time and energy and understand. Number 6, this one is really simple, but at some point you just got to do. Okay. So many people are in analysis paralysis. They just don't pull the trigger. They're waiting for this, they're waiting for that. And at some point, you've just got to do it. You just can't wait any longer because you want to put your money to work. Time is on your side in real estate. So again, the goal is you're going to make money in your sleep. So again, your job, you're trading time for money. You want to put your money to work. So when you go to bed, your money keeps working for you. Folks like myself and my team, we're working on the deals. We're doing the different things so that you can sleep. All right, anybody recognize this guy here? If you don't find a way to make money while you sleep, you will work till. It's as simple as that, right? And I didn't start real estate investing till 58. So I'm super passionate about getting people. I got to work extra hard just to catch up because I've traded time for money. All I did, I had a good job. I did different things, traded time for money. And I wish so much. Everybody says, when's the best time to plant a tree? 20 years ago. What's the second best time to plant a tree? Today, right? If you want to sit under the shade, at some point you have to be able to plant the tree. So we're going to talk a little bit about that. A real estate syndication is a group of investors who pool their money to buy or develop real estate. Syndications are a way for investors to invest larger properties that they could not afford on their own. So I often tell this story. I invested in a $40 million property in Denver. Okay. I put $50,000 in that deal, but I could $1 million property. I could probably never buy $1 million property. I own it. And it doesn't make sense. There's a lot of power in the lever, but it gives you the opportunity to own an actual piece. So I can go up there and I can tell the owners that, hey, I'd like to go look at the property, and I can do a tour of something I own and see what's going on. So syndications are totally passive. That's what we're talking about tonight. So sponsors or general partners, they're experienced real estate professionals who organize the syndication, secure the funding, and then implement the business. Investors are often called limited partners, used as short form LP. Sorry, this is GP, this is LP. They fund the project. They own a portion of the asset. The typical structure we use is an LLC framework, but you will actually own a piece of the LLC that owns the real estate. Some of the benefits, your liability protects your personal assets beyond the end. So what does that? Something horrible happens in an apartment complex. The only thing you have at risk is your investment. You're not responsible for anything. I want to make sure I'm clear. You are at risk for your investment. You can target so you can find somebody who really good at really good at retail development, really good at mobile home, really good at storage. And again, you want to find these. I'll tell you a little story. There was a group that I wanted to invest in North Carolina passively, and they kept having multifamily deals. But at the time, I thought my portfolio was out of balance. So I wanted something in the Charlotte, North Carolina market. I wanted to do a storage investment, and I patiently waited, and about 18 months came along and it was perfect. I had some money come liquid from another investment. They were building a new build storage in Charlotte, North Carolina. And so I could invest in. Now, would I invest in a storage unit with somebody that I don't know, that I don't like, that I don't trust? No. So again, I wanted to do a deal with these folks. I spent the time to get to know them. I kept passing on their opportunities till they had something. So again, through syndication, I would never be owning it. That's my only storage right now. I would never own a piece. And then your returns are directly tied to the project's success. So again, most of the deals that we structure, investors get paid a pref payment first. So you get first. Then when we make profit, there's a split of the profit after you've received your payment. And then sometimes there's what's called a waterfall where it's a bigger split for us. So again, the concept of the deal is when you're investing with a group that you know, like, and trust, and you understand, you get paid first. And until you get paid, we do a 7% pref. So until you get 7% accumulated, we don't make any money. Then when we get into you've made that, we start what's called a split. So we may make 30%, you may make 70%. And some of our deals will go as 50. And I know that's a lot. I'm going to go through some of this stuff a little bit quicker, but for real estate, you're going to use CC attorney. Actually, mine was at my luncheon I went today. He's a great guy. He's going to create a private placement memorandum, which is called a PM, which details all the investment risk and disclosure. You want to get really blown away, read a piece. It's okay. We can send you one to look at. It's basically 100 pages of anything that could go. I mean, it's just what it is. It's all about it. There's going to be an operator or a limited partnership, and it's going to outline the investment structure and roles. So again, it's another document that says, here's the private placement memorandum, which tells everything. So we are selling a security, and so we have to follow certain rules. And then there'll be a subscription, which basically says, you've read the rules, read the operating agreement, signing this subscription agreement, and it goes through is where you agree to invest syndicate. So again, you'll say, oh, I'm interested in looking at an opportunity. You'll read all about it. You'll create an account. You'll download the PPM. You'll look at it. And once you decide you're going to sign it. We take a look at all of your questionnaire and all of the things. We re-sign it, and then we'll send you a place where you can transfer money. We talked a little bit about this earlier, the percentage splits. They can be anywhere from 10 to 50%. I've never invested in anything that has higher than 50. I've seen it, but I personally have never invested in anything that's bigger than a 50% split. And again, this is normally, so what I mean is on a 10% split, 90% would go to investors. I normally stay away from those deals because it's too investor friendly. I want a deal where investors make money because that's the best. Splitting it with everybody. There could be a structure with a waterfall. There's acquisition fees. That's part of how we make money on the active side. So we'll get some money when we close the deal. We'll get some money for operating the deal. We'll get some money on a disposition for refinancing or sale of the deal. And then if it's a construction project, we may get 5 to 10% management fee on top of that because there's a lot more work that's involved in project management. So there are some rules for syndications. So there are two types of syndications that we use, a 506B and a 506C. On a 506B, I can't talk about my deal to anybody that I don't have a pre-existing relationship and is considered a sophisticated investor, understands the basic risk reward. So they refer that I have to have a substantial relation. So if I had a deal tonight and it was a 506B deal, could not talk. We're in a public format. This gets uploaded to YouTube. I cannot talk about it, but you do not have to be an accredited investor to invest in one. Then there's a 506C, again, which has no restrictions on solicitation. So I can sing it in my neighborhood. I can talk about it on this webinar. Could have talked about it at my lunch today. So it gives the biggest availability to the market, but only accredited investors invest. And that means excluding your home net worth of $1 million or more, or a single income of 200 and a family income of 300. I want to make sure that I'm clear. There is no difference between a 506B or a 506C other than who can. And at Massive Capital, we often start our deal 506B. We kind of call that the friends and family. So you're not accredited, but you'd like to start getting into real estate investing. You'd like to start to have your money working for you. So we'll normally launch a deal, and then we can only tell our pre-existing established relations. So again, we have about 12,000 in our database, and about 1/3 of them we have an existing relation. So when we have a deal, we can invite those. And then once we switch it to a 506C, we can invite everybody in our database. And we normally do this for about 4 to 6 weeks, and then it's about 6 to 8 weeks for this particular off happen. And the reason we do it is we want you to start. We don't want you to wait till you're accredited. We don't want you to wait till you've built up that net worth. We want you to be able to put your money to work earlier so that you can reach for your. So ways that you can invest. Okay, you can invest in cash. Pretty simple and obvious, right? And you can invest as an individual. A lot of people say, oh, do I need to have an LLC or a company or a trust? You do not. Because you're a limited partner, you have limited responsibility. You would want to talk to an accountant or a lawyer to determine, do you want to do some of these other. So for example, me personally, I have always invested through an LLC. And the reason for it is that LLC allows me to do others within the LLC. So there's cost to manage an LLC. But for example, if I was an individual and I fly to Charlotte to go see my storage unit, and by the way, my brother has lived, if I do it through my company, the IRS says I'm allowed to fly out there and engage in business. I don't have to work over the weekend. So I can fly out on a Friday, do some work, see my asset, spend the weekend seeing my brother, and then do some more business, fly home. So determine a pre-existing relationship means that we've had conversations and we've gotten to know each other. It's kind of a gray area. So, but we have to know you. So I'll have a couple of conversations with you. I'll make sure that you understand what we're doing on investing. All of this is documented in our customer relation management system. And then once I feel, okay, I know this person, they know me, they understand the risk, I give them that tag in the system. So that's a great thing. A lot of people don't know this, but you can invest with your retirement, all different types of retirement funds. Normally, you cannot do it while you're still employed. Your employer does not want to give it. And you need to understand that most retirement funds are tax deferred. Now, a Roth retirement fund is tax free, very powerful. And we'll talk a little bit more about an example of that, but they don't qualify for the passive loss force. So yeah, that's a great answer. Very good answer. So some things to consider. They're not liquid. When you invest in my deal, you're going to be in the deal for 5 years. You really can. It's very challenging. These are not risk-free. You can lose some or all of your money if a deal goes poorly. A good general partner will disclose these risks. All the risks have been put in the PPM, but there are risks. Limited partners do not have any control of decisions. So basically what happens is we present a business plan. We have every right midstream to change the business plan, do what we think. But again, remember, our interests are aligned. Hopefully you've invested with somebody you know, like, and trust, so they're not doing things that favor them, but they're doing things that favor the deal because our interests are, but you don't have any control of the decision. You can't pick up the phone and say, well, Trevor, my kid's going to college. I need you to sell that apartment complex and make everybody liquid. We just can't do. We already mentioned you can invest with cash or retirement funds. Individuals already did that. Make sure you consult a tax and a legal professional for guidance. And then we, as the general partners, operate the property and decide whether to sell or. So again, we make all the decisions, but the decisions are basically in your best interest. So again, every investment has a different balance of risk reward. There are all types of different presentations and timelines. Excuse me, there are different tax scenarios. So for example, sorry, I'm going to take a drink here. On our multifamily, you do get the passive losses. On our retail development, you don't get the passive. So you need to understand those and make sure you're asking those questions. And so for example, if you had a retirement, it's perfect for the development deal because you can't use the passive loss anyway. So again, making sure that somebody helps you and educates you. And then you need to understand the different return. And at some point, we're going to do a little more deep dive into this. This one is my favorite. It's called IRR, and it's an internal rate of return. And it talks about the profitability of an investment over its entire lifespan, considering the time value. All right, so I'm going to explain the next one and then go back to IRR. Exit multiple is your investment will grow. So for example, is your investment going to 2x in 5 years? Okay, so let me give you an example. If I 2x your money in 5 years, that's about a 17% IRR. If I double your money 10 years, that's about a 10% IRR. So you want, because it's the time use of your money. Now, if I have a property and then we're able to do a refinance and I can give you a portion of your money back, that accelerates the time use of your money. So you put 100,000 in, you got 50 back, you can redeploy that 50 and your other 50 is still working. And on the exit, your IRR would be higher. I know it's a little bit complicated, but it's just some really big things for you to understand. Average annualized is basically just what does that work out to on an average over 5 years. Cash on cash means how much cash flow does it produce? Is there a preferred return? So it's a predetermined rate of return before GPs get a split. And there could be a waterfall split, as I mentioned earlier, where the split change. Still a better way than losing your money at the bank. So again, you need to understand the risk. You need to understand the reward. You need to understand how long is your money going to be tied up to make sure that you have planned for it. And you want to make sure that you understand a little bit about your asset class. So the quick question here, the earned income is 200,000 as a single, 300,000 married. And it doesn't, so the value of your home is on your net worth. So it's a net worth of $1 million, not including so any asset. So that can be your ownership of rental properties, anything that you have. I had a guy who used Rolex in his personal financial statement, a very expensive Rolex that he inherited, and he had it appraised, and it went towards it. So that's on your asset. And then the other way is on your income. They have just produced, and you have to have, we have a third party that verifies this. So when you're investing in an accredited deal, you will need to send whatever documentation to a third party, and then they use it. So often, if it's on income, you just send in tax returns or different things. And if it's on assets, you'll need to send a copy of your bank accounts, your portfolio. Kind of like if you're pre-qualifying for a mortgage, they're saying, what are all the pieces? That's what you need to provide to this third party. Great question. So real estate investing is like playing a baseball game. If you go up to the bat and you think you're going to hit a home run every time you're it, and that's how you're going to win the game, I think you're mistaken. You need a variety, right? No baseball team sends everybody up to hit a home base, right? You want to get some singles, you want to get some doubles, Now, you may not know which ones are doubles or singles or whatever, but you show some sort of idea. So for example, I'm invested in a medical. And remember, we talked about returns of doubling your money. Well, I'm in a medical center and it's 1.5 times my money in 5. But I'm okay with that because I understand the risk. This is a medical center, triple net lease, which means the tenants pay all of the expenses. The doctors personally are guaranteeing their leases, and their practices personally or corporately guaranteeing. These things are not going to, unless a doctor has something where he loses everything. And it's just, so it's a super safe bet. So again, I wanted to make sure that I had a couple that no matter what, I knew every quarter I was going to get. Sometimes some other deals, you may not. You want to make sure, okay, I had one deal that tripled my money in 20 months. I'd like a few more of those, please. And that turned out to be like a 53% IR. Very unnormal, but it can happen. Obviously, that's a grand slam, but they were only predicting. It just happened to be the way the market. So this is something I really want you to get your head wrapped around. A lot of people say, oh, I want to start investing in real estate so that I can quit or do different things. And that's a great thing to want to do. But I want to talk to you about the power of compound. So if you remember earlier, we talked about my friend Warren Buffett. It's not really but I listen to him a lot, so he feels like it. It's the compounding. So recently I turned 65. And one of my mentors sent me a note saying that Warren Buffett created 90% of his net worth after the age of 65, and it was due to compound. So again, let's do a little math here. That's $100,000, assuming you double your money every 5 years and you have no tax consequences. We all know double your money comes to 2. So if I put my money back to work, 200,000, I invest it for 5 years. Again, I double my money with no tax. I take the $400,000, I invest it, tax complications, you double it's 800,000. I take the $800,000 and I invest it, and in 5 years it becomes $1.6 million. I invest the $1.6 million, and in 5 years it becomes $3.2 million. I want to make sure that you're grasping. This is all from one initial $100,000 going to work while you go. Now again, this is best case scenario, right? So let's say you got really bad luck and in 25 years you only make $1 million. Still way better than all of the things, right? All of the ways that you're growing to grow your. So again, I know 25 years is a long time. I'm not sure if I have 25 years left, which is why I'm working extra hard to get there. But you want to make sure. So again, if you were to say, I need the money, I'm going to quit my job. If you put $100,000 in, made 2, lived off 1, you're going to invest 100, it's going to be 2, you live off. At the end of 25 years, you're going to have your 100K left and you live. That may be what you want to do. It's your financial freedom. But how many people, if you'd made a sacrifice as a younger you and just scrimped and saved and invested and let that investment grow, this be making significant difference in life we're all getting. So let me tell you one other thing, my new pet peeve. Let's say I was really, which I wasn't, and I converted this $100,000 Roth IRA. Gotta remember, this is just tax deferred, right? When I start taking this money out, I'm going to start tax. If I converted my money to a Roth IRA, which means I prepaid the tax, and this happened to me, I would be taking $3.1 million out tax free. Pretty powerful. So again, start investing early, keep your money moving. And again, even if you stop somewhere in here, and this is only based on one investment, letting it roll. So one of the things I want to talk to you about, if you're interested, we do have an apartment unit in San Antonio, Texas. It is for 506C accredited investors. I've already put my link in the chat. So if you're interested in learning more about that investment opportunity, please reach out to me. If you're in the San Antonio area this Thursday, I'm actually doing a tour of this property. And our goal is on this tour is to show you how do we do value add multifamily. So again, connect with me. It's on our pages. You got to sign up to get the address and everything. But it's an amazing investment opportunity, but it's an amazing learning opportunity if you want to really see something. For those of you that don't know, every other week we have our ladies group does a presentation. So 1 week it's me, 1 week it's them, just to show everybody how have it up here. I have a thing, can't believe it. I went to one of their events and I wore a wig. So it's pretty funny. So again, coaching and mentoring changed my life. I'm a limited partner in 20, general part 12. Make sure that I talk to you. If you're interested to learn more about going active, and we're going to talk about that on a frequent every Tuesday night, we do a lesson that talks about how do you go from a passive investor to an active investor. So we do these every Tuesday and Thursday evenings. You can scan that QR code or ask me at the end and we can give you a link to do that. And then these are followed up by 3-day trainings where we have them in Austin, Houston, and Dallas. They happen on a rotating basis where you actually spend 3 days with our entire team and learn everything about becoming an active real estate investor. And again, my goal is to help 100,000 people reach financial independence through real estate investing. It was interesting. So I originally had a goal of 1,000. Then I listened to Grant Cardone's 10X. And then I was making this presentation last fall, and one of my mentors, Phil Grove here, who, by the way, has coached over 4,000 people about becoming active real estate investors in the commercial space and in the single family space. He came up and said, no, we're changing that to 100,000 people, get to work, start getting more people doing it. So again, everything starts with you, and anybody has it. I've been watching the chat thing. So it's different, right? So a passive is your money going to work for you. An active investor is you going to work to earn your. So being an active investor is not a get quick, it's a get rich slow. Okay, so I don't really make any money on my deal sell. So if you said, well, I'm going to quit my W-2 job and the payday's 5 years from now, you're going to get hungry pretty quick. You'll get some money on acquisition fees, but it's the accumulation, right? So that being an active sponsor really helps build your net worth. But on a tax, and again, I'm not an accountant, as a passive investor, you can only write off appreciation on passive losses. As an active investor, which means you're actively managing. So it is your main full-time job where you're managing properties, you're managing deals. So that's all I do, right? I go to property management calls, I go to KPI calls, I go to general partner calls to investors. That's what makes me an active real estate investor. So all of my passive losses go against so again, that's why Donald Trump said he pays no taxes. I'm in the same boat. I haven't been paying any tax. Now, some of them are deferred. When you get recapture, it can come back. But again, it's not how much you make, it's how much you keep. That's a great question, though. Thank you. It was good to see you today. Any other questions? Oh, Natasha, my favorite person. Natasha shows up at everything. Sometimes she can't unmute. Any other questions? It's great to see some familiar names here. I really appreciate you showing up. Oh, so if you want to join the San Antonio investment, just book a call with me, and I would be more than happy to get you. And then if you were asking about the property tour, I'll put that link in the chat here. And you would register for that property tour. But the best thing to do is to get in touch with me, and then I can send you all the deck and all of the recordings. Yeah. Any questions? Are you all asleep, or was that good? We will have a tour too here in Austin for our new retail. It's going to be end of April. And the goal of these educational tours, right? It's so important for you to see it, right? I mean, we're telling you, hey, you're going to own a piece of a real asset. Well, don't you want to touch it, see it? How do we make money? So we bought 5 acres of property. We do different things. We want to show you. So I often post videos, and then we decided, we really need to do education. So we have another project in the San Marcos area where we're developing about 110,000 square feet of industrial storage. Right now, we just poured concrete, but we're going to start bringing an offering. I know it's hard for those of you that aren't in Texas. You'll just have to move here. Everybody else says Texas is a hot place to grow. Awesome. Any other questions? So again, I'm going to put my link in here for you to go ahead and book a Zoom call with me. Happy to answer any individual questions. I love talking about real estate investing. That's why I called it Massively in Love. I wish I had found it earlier. I often tell my story that I was always interested in real estate, but I was terrified of toilets, tenants, and trash. And I just didn't want somebody calling me in the middle of the night saying their toilet's not working.
Yeah, Trevor, thank you so much. My name is Hosseini Abiri. I'm based in.
Yes, sir.
I am a nurse practitioner. I've been interested in real estate, more so in commercial, but again, just like you said, is the fear that has really delayed my taking action. So it would be interesting to talk to you. I've booked a section with you already.
Awesome.
So my question is that if you have 401k still sitting there, because I want to
Yeah.
channel, if not everything, towards real estate, do you have resources? How?
Absolutely, yes. So we have a preferred company. It's not the only one, but
Okay.
we have a preferred company that we've been using. Just so you know, I have my accounts with them, and they're actually doing a big training session in Austin. But it's overkill if you're just looking. But what you do is you set up an account and then you
Hmm.
just roll your money into it. There's definitely a procedure you need to follow. Like
Hmm.
money has to go into the IRA, it can't go to you into the IRA.
Correct.
Yeah,
Okay.
yeah,
Now, so you've worked with them on your project, this preferred company?
that is correct. Yes, and I
Okay.
have my money in them, and I invest with that money, and then I
Okay.
recommend it to our investors
Okay.
all the time. And I actually went to Phoenix last fall. They had a big 3-day conference, and it was right when we were looking to switch to use them. And again, I was super impressed.
All right. Anyway, I have it with you. Really love to have a conversation about that with you
Perfect, awesome. Looking
on
forward to
this
it. Thank
journey.
you.
All right. Thanks.
Yeah, so the question was about cash flow. So different deals have different cash flow. I'm going to be honest, right now multifamily is a little bit tough for cash. There is some cash flow, but right now it's kind of challenging with the higher interest rates, a little bit of downward pressure on the economy. Doesn't mean that there are some other opportunities. We've got a group of folks in our mastermind. So we have a mastermind, it's about 150 people in it. And we're starting to look at assisted living. And assisted living and mobile home parks are generating a little more cash flow, but they don't appreciate as high. So kind of, if you get what I mean. So, again, on multifamily, you may make 30% of your profit on cash flow and 70% on the sale. Well, maybe on those other ones, about 40% on cash flow and 60% on sale. Hopefully that helps. And again, ask those questions, right? What's happening? What do I need to do? And we're in different cycles of the economy, and right now is just a tough cycle for cash flow. I wish it wasn't. So yeah, getting a down payment for multifamily is super hard. Again, that's why we have our mastermind with our big network, where we only work on helping people that are within our organization to go ahead and take down deals. We don't do any third party. There are some folks out there that will give you some earnest money, but it's going to cost you, and it better be a good deal. I've got a couple of friends that do it. Again, book a call with me. I'd be happy to introduce, but they're going to want collateral, and so unless you have collateral to offer, like, so again, we were buying $1 million piece of property, and we had to put like $2 million collateral to borrow $1 million, and we paid it back in 3 months, but it's super high, and that's called opportunistic, right? The best way to make money is eventually, what my goal is, they call it a key principal, where you are wealthy enough to either do this earnest money for deposit or to be a person signing on a loan. So again, for example, that property in San Antonio I told you about has a $10 million loan. To be able to sign the loan, to have the experience of being able to operate a larger property like that, you need to have a net worth of $10 million or more, and you need to have at least $1 million liquid. So again, there are a lot of things that move in the general partnership team brings to a deal. And that's where a lot of our skin in the game is on these deals, where we bring money into these deals, we put our own money at, and then that's how we make these things happen. So, well, this was awesome. I really appreciate everybody showing up. If you enjoyed tonight, please invite a friend to come back. If you were late and you want to check out the replay, they get posted on our YouTube page. We ask that you go ahead and subscribe to it. And any more questions? We finished right on time. Awesome. Well, I really appreciate everybody showing up. And again, if you enjoyed yourself, please come back in 2 weeks with a friend. Thanks, Audrey. It's hard when everybody's not on their camera. I like to see people. All right. Good night, everybody. Thank you.
Thank you.
Oh, there you are. Thank you. Good to see you. Take care. Bye-bye.